Well, it's been a busy day for central banks. The Bank of England, the latest to raise interest rates, joining peers in the US, the Philippines, Switzerland, and Norway, and choosing to fight inflation. That's even as the dust hasn't settled over the closures of US regional banks and the forced takeover of Credit Suisse. Now, the BOE lifted borrowing costs by 25 basis points to 4.25%. It is the 11th time it is increasing interest rates as inflation in the UK shows no sign of easing. It unexpectedly rose to 10.4% in February, not far from the 41-year high of 11% in October. The Swiss central bank also hiked interest rates by a hefty half a percentage point to 1.5%. It is decided to focus on tackling inflation as well, despite turmoil in the banking sector. Now, the Swiss National Bank declared authorities had halted the crisis at Credit Suisse after a historic government-backed rescue by UBS. And right here in Asia, the Philippine Central Bank has slowed the pace of its interest rate increases. It raised its benchmark interest rate by 25 basis points to 6.25%. The move brings the cumulative increases since May to 425 basis points. The BSP's move mirrors the Federal Reserve's. Overnight, the U.S. Central Bank pushed ahead with a quarter-point hike. This brings the federal funds rate from 4.75% to 5%. It marks the 9th increase in a year. And for more, Yeap Jun Rong, market strategist at IG, joins us. Mr. Yeap, in view of all the rate hikes that we've seen in, just the past 24 hours, and that's when the dust hasn't settled over the U.S. regional banking crisis and Credit Suisse's forced takeover, do the central banks run the risk of over-tightening when the financial sector is already under stress and the global economy is slowing?
Yeah, I think currently central banks clearly face this difficult task of having to tackle inflation and also trying to stabilize sentiments around the banking space. But at least for now, I think the banking crisis in a way does suggest that central banks may have to turn towards more measured rate hikes moving forward. Because in a sense, I think this crisis by itself have kind of tightened credit conditions in the economy. And if you look last month, expectations were still leaning for a 50 basis point hike from the Fed. We have 25 basis point from the central bank yesterday. And looking today, Philippine central bank has also downshifted their rate hikes to a 25 basis point. So in a way, I think this banking crisis have forced central banks to kind of take a step back and to adopt, this trying to downshift this rate hike process to achieve this middle ground so that they can still continue on this fight against inflation, but at the same time also have the policy flexibility to, adjust their policy stand in times of economic uncertainty ahead. So I think the risks of over-tightening are still there, but at least for now, I think central banks are adjusting their stance to minimize these risks.
Yes, well, inflation, remains front and center. What could be the drawback on focusing too much on fighting it instead of, easing liquidity and stress in the banking sector? As some Asian central banks have already paused rate hikes, what would be the overall impact of the uneven pace of tightening on this region's growth?
Yeah, I think the current tricky part is really about balancing. It's really balancing on the fight against inflation and trying not to create further jitters around the financial instability. But I think, when we talk about this banking crisis bringing on tighter credit conditions, I think in a way it has really a deflationary impact on pricing pressure moving forward. So I think central banks clearly have to adjust to it in terms of a lesser scale of rate hikes and to adopt more of a wait and see moving forward. Because if they don't, then that really runs the risk of a further over-tightening, and we could potentially be looking at an increased risk of a hard landing or even a potential recession over the coming months.
So far, investors, they assess that Asian banks are relatively immune from the U.S. regional banking crisis. Is that really the case, though? Because Japanese banks, they've also been more adventurous in lending to combat negative rates at home.
Yeah, so when we look at recent share price for the banks across the region, obviously when we look at Japanese banks' share price, they have clearly taken on a heavier hit than the rest of the region, considering that they are more inclined to turn towards bonds buyout as opposed to lending out their capital due to the negative interest rate environment back home. So that really run the risk and also concerns from investors that Japanese bank could face similar situation as the SVB in terms of having to absorb heavy losses due to lower bond prices. So I would say we are not clearly out of the woods across the region, and there are also the risk of US potentially falling into a hard landing if the banking crisis is not being contained. So that could be this spillover effect onto our regional economy, especially when we are so exposed to external demand for our own growth. So at least for now, I think our local banks are still more well capitalized with a very diversified funding space. So we are clearly in a better position to weather any contagion risk. But for now, I think markets are still in this jittery mode. But once the dust starts to settle, I think investors could start to turn a greater focus on the underlying fundamentals, and that is where I think our local banks have the opportunity to shine and to regain some renewed traction from in that sense.
Well, many thanks for that. Yeap Jun Rong, the market strategist at IG.